Hi, I'm Rob Lockhart from Westpac's Davidson Institute, here to talk to you about starting a business. There are many reasons people want to start a business: to make money, to be your own boss, or perhaps to build a legacy for the family. Building solid foundations for the business to operate and be sustainable is absolutely essential. It can be a lot of hard work and you'll have ups and downs along the way, but with careful research and planning, you, like so many others, can make your dream of being a business owner come to life. In this video, we're going to take a high-level look at the process of starting a business and some of the many considerations that you need to make along the way. Every business starts with a vision of what you are aiming to achieve in the business and why. Once this is clear, you need to develop a plan for how the business will operate so that you can achieve what you set out to achieve. The rubber then starts to hit the road in the creation part of the process. This could be considered sometimes the boring bit, all the paperwork, dotting the I's and crossing the T's. However, this step is absolutely essential to successfully launching your business. Every business owner in the world started just like you, with an idea or passion that they believed could make them money. Your idea or passion is your vision, and your business is one way of bringing that vision to life. But do you have what it takes to bring it to life? Research indicates that there are a number of character traits that are common to successful entrepreneurs. They include things like courage, drive, independence, confidence, passion, leadership, ideas, innovation, and resilience. It's one thing to have a great idea, but quite another to go it alone to bring that idea to life. Because when you are starting your own business, you are definitely going it alone. You alone are responsible for the success of your business. So you need to ask yourself some tough questions around whether you have what it takes. Questions such as, how much time and money am I prepared to risk on this business? Do I have the resources, financial, physical, and mental, to see this through? How will I stay motivated when things aren't going well? It can be a lonely place at the top, but if you are the right person for the job, then it can be a very fruitful and fulfilling place to be as well. Okay, so if you are confident that you are the right type of person to run your own business, the next questions you need to ask are what and of course why. What is it that I actually want to get out of running my own business? And why do I want that? For most people, part of the answer to this question will be, and of course it needs to be, to make money. But even this simple outcome has a number of different scenarios. Do I want to make lots of money? Do I want to just make enough to take care of the family and be able to spend quality time with them? Do I want to create a legacy for my family to carry into the future? For many people, the what and why is simply a chance to work at something they enjoy doing. And for some, it's just the opportunity to use their skills and knowledge to improve the lives of others. It's important to be very clear in your own mind what you want to achieve and why, as this will help to focus your planning. While there are many successful businesses out there that don't have a comprehensive business plan, to my way of thinking, having a business plan is absolutely essential. Having said that, I believe the greatest value of a business plan actually lies in the planning itself rather than the end product. By developing a business plan, you give yourself the opportunity to explore different scenarios, decide on a path that you think will get you to your destination, and what actions you'll need to take to get you there. It's a bit like a roadmap or GPS for your business, focused on your destination and providing guidance for how to get there. To help with that plan, at the Davidson Institute, we use a framework called the 7 Ps. The first P, and we've already looked at this to some extent, is called purpose. In asking the what and why questions we looked at earlier, we were thinking about the purpose of the business. By identifying this purpose, we can then center our business on this, and all our other decisions and actions should be aligned to achieving this purpose. Some of the tactics that we can use to achieve that purpose are our product, people, place, price, and promotion. Firstly, your product or service. An effective business plan will include things like exactly what is it? What is it that you are selling? What do you need to put it together? How does it actually go together? And of course, what benefit does your customer get out of using your product or service? By clearly defining what your product is and the customer problem that it solves, you can remain focused on delivering a product that is valued by your customers and that they want to buy from you. Then the next one is your people, those who are going to help you achieve your purpose. When you're planning, it helps firstly to think about all the jobs that need to be done and what time and skills are required to do them. This then translates into the people that you will need. Next is your place. Where will you operate from? Home, online, a shopfront? And of course, in what location? How much area do you need? And what facilities does your place need? And whatever other questions you need to work out your place. The next tactic is price. How will you set the price of your products or services? What's the value proposition to the customer? And how much are they prepared to pay for it? Will this make you sufficient profit to be successful? Then our 6P is promotion. This is all about how you're going to communicate with your customers and your potential customers. How do the right customers know that you have the solution to their problem? How are they persuaded to buy from you? What would encourage them to come back and buy again, or maybe recommend you to other people? Then the final P is performance. How do you measure whether you are successful or not? And of course, achieving your purpose. Having an effective system in place to measure how well your product, people, place, price, and promotion have helped you to achieve your purpose, I believe is absolutely essential. Addressing the 7 Ps in a business plan helps to build a strong foundation for your business. For further insight into business planning, watch our videos on business planning on the Davidson Institute website. Now it's time to start creating the business and bringing your whole business idea to life. This part of the process may not seem as exciting. There are many I's to dot and T's to cross. However, you will be thankful in the end if you've been thorough at this stage. When creating your new business, you'll need to select the right legal structure that will help to keep your tax to a minimum and protect your assets. We're going to look briefly at the most common structures and the various pros and cons of each shortly. You'll also need to ensure you are aware of the statutory obligations of being in business. So we're going to look at some of these as well. You'll also need to consider how you'll fund the creation or launch and ongoing operations of your business. And finally, you're going to need to think about risk management. What are the things that could go wrong in your business? And what needs to be put in place to reduce the impact on your business? Let's start with the business structures. There are typically 4 main types of structures. It is important to understand the advantages and disadvantages of each structure and, where necessary, seek professional advice to set up the business in a structure that is right for you as the owner as well as for the business. Remember too, that changes to the business structure in the future could be costly. For instance, if you intend to grow significantly over time and employ people, it makes sense that your structure will need to be different than if you intend to only ever operate on your own. Speaking of which, our first structure here is sole trader. As a sole trader, you simply operate as you. You are one person. You are personally liable. You are taxed at your personal marginal tax rate, and you have full control. One of the key drawbacks of this structure, though, is that you only have your own resources, intellectual, financial, and so on, which may be restrictive to growth. You are also personally liable for any debts of the business. Our next structure is a partnership. A partnership can be up to 50 people. The profit distributions are governed by the partnership agreement, and distributions are taxed at the partner's personal marginal tax rates. With this type of structure, you have access to the collective knowledge and funding of all the partners. The challenge potentially being to get everyone to agree. However, remember that there is limited protection for personal assets with this type of structure, as each partner is often jointly and severally liable for all partnership debts. Another structure to consider is a company. The advantage of establishing as a company is that there is limited liability for company owners. The company is its own legal entity and as such can trade and borrow as itself and is liable for its own debts. Company profits are currently taxed at a flat company rate. A company is more expensive to establish and administer. However, it can offer protection for personal assets and be easier to manage a change of ownership in the future. A trust is the most complex of all the business structures. However, it offers most protection for owners and most flexibility in distribution of profits. A trust is established via a legal document known as a trust deed. The trust deed appoints a trustee who manages the finances of the trust on behalf of the beneficiaries of the trust. What the trust and the trustee can and can't do are set out in the trust deed, as are who the beneficiaries are and what their entitlements are. A trust is a financial entity as opposed to a legal entity. Assets and liabilities are held on behalf of the beneficiaries of the trust, not actually owned by the trust. Profits are allocated to the beneficiaries and then taxed at the beneficiaries' income at their own marginal tax rate. While this structure is more complex and costly to administer, it offers limited liability for beneficiaries and more flexibility for distribution of income between those beneficiaries. It is often used by family businesses that may span a few generations or where owners have substantial assets or other interests outside of this particular business. Talking to your lawyer, your accountant, and your personal financial advisor will be helpful when selecting the legal structure for your business. And remember to take into account what you want to happen with the business in the future, not just what works right now. The next part of creating the business is to understand your statutory and legal obligations. Non-compliance with any of these may lead to substantial fines, audits, and remedial work that could jeopardize your business. So it's very important to get this part right. There are four main areas to look at. Let's start with registrations and licenses. The first one under this heading is your Australian Business Number, or ABN, which is a unique number that identifies your business. You'll also need a tax file number, or TFN, which identifies your business to the tax office. Sole traders will use their own personal tax file number, but partnerships, companies, and trusts need their own tax file number. If you are going to be structured as a company, then you'll need to register with the Australian Securities and Investment Commission, or ASIC, who will issue you with an Australian Company Number, or ACN. Relationship Authorisation Manager, or RAM, is a secure logon that identifies the business when it uses a government online service such as the Australian Tax Office's Business Portal. There are also various federal, state and local council regulations requiring different licensing, permits or registrations for various industries. The Australian Business Licence and Information Service, or ABLIS, helps find this information. And unless you are going to operate just under your own name, then you need to register your business or trading name. A sole trader can simply use their own name, such as Mick Brown. But as soon as you add anything to it, such as Mick Brown's Garage, then that name needs to be registered. A company can also use its own name, but again, if you wish to use anything other than the registered company name, it also needs to be registered as a business name. The second area we'll address here is taxes, starting with the GST, or Goods and Services Tax. If your business provides goods or services on which GST is applicable, then you must register to collect GST if your annual sales exceed $75,000 or if you are a taxi operator. The GST of 10% needs to be included in your price and recorded on your invoice or receipt. The GST you collect and the GST you pay are reported to the Australian Tax Office in your Business Activity Statement, or BAS. Now, depending on the size of your business, your BAS can be completed monthly, quarterly, or annually. It's a good idea to discuss with your accountant which is the most suitable for your business and your cash flow. Another tax you'll need to manage is PAYG, or pay-as-you-go withholding tax. You'll need to register for PAYG if you are withholding monies from payments to others, such as a business that does not have an ABN, or the taxes you withhold from your employee wages. Again, this tax being withheld from payment needs to be collected and submitted to the tax office. You may also be paying PAYG instalments yourself, based on your anticipated income, which are then netted against your end-of-year tax return. If you are employing people, then you'll need to use the tax office's single touch payroll system, or STP, to report wages, tax and superannuation. FBT, or fringe benefits tax, is applicable when providing benefits to yourself or your employees, such as private use of a business motor vehicle, club memberships, holiday expenses and so on. This is a complex tax and best discussed with your accountant. These are just a few of the taxes you will need to manage. For more information, refer to the Australian Tax Office website and your accountant. Another area you need to stay abreast of is superannuation. As an employer, you are required to make contributions to your employee's superannuation fund, known as the Superannuation Guarantee. Any employee who is 18 years or over and earns $450 or more before tax in a month is entitled to a percentage of the amount they are paid to be contributed to their super. This percentage is currently 10%, with gazetted increases over the next few years. There are very tough penalties if this obligation is not adhered to, and lots of legislation involved. Make sure you talk to your accountant and get this right. Again, there is more information available on the Australian Tax Office's website. The last area we'll look at here is to understand your obligations as an employer and what your employees are entitled to. There are rules around what employees are entitled to at work, including, but not limited to, hours of work, rates of pay, leave entitlements, and so on. The National Employment Standards set out the 10 minimum entitlements that must be provided to all employees. Information on these standards is available on the Fair Work website, fairwork.gov.au. In remunerating or paying your employees, ensure you are familiar with the Modern Award, which sets the minimum employment wages and conditions for an industry or occupation. Award details and other information can also be found on the Fair Work website. Getting your statutory and legal obligations right is an important step in setting up your business. There is plenty of information available online, but having a good accountant and lawyer will be invaluable as you go through this process. The next thing we're going to take a look at is how you might fund your business. There are two types of costs that you'll need to account for: your initial setup costs, then your ongoing capital expenditure and operating expenses. Let's start with the startup costs. Getting your business up and running will incur a lot of different costs, from licensing and registrations, the professional fees from an accountant or solicitor that will help with your setup, marketing and communications such as business cards, flyers, a website. There'll be staffing costs, insurances, and the list goes on. And of course, office establishment costs such as a bond on a rented office, furniture and technology for your office or shop. It's important to understand which of these costs you might incur, how much they are likely to be, and how you are going to pay for them. Do you have sufficient cash set aside? Will you need a financial partner or investor to get started? Will you need to borrow for some of the bigger ticket items such as a premises or machinery? The money you spend on items such as premises, equipment, technology, and so on is known as capital expenditure, or CapEx. In general, the money to purchase fixed assets, the money you spend on items such as premises, equipment, technology, and so on is known as capital expenditure, or CapEx. In general, the money to purchase fixed assets, such as equipment, plant and machinery, premises, vehicles, and so on, comes from two sources. The business owners or investors in the form of equity, or from external sources such as credit from your suppliers or loans from the bank. These are known as creditors. Getting the right balance between these two sources of funds is important to long-term success. Too much borrowed money can be expensive and risky for the business. But as an investor in the business, equity providers should be concerned about the effective use of their investment and the return that they are going to get from that investment. The other type of funding we need to plan for is the everyday operating expenses, known as OPEX. This includes buying stock, paying wages, rent, maintenance, marketing, and the list goes on. Part of this funding is also referred to as working capital. The key to managing OPEX or working capital is to have an understanding of the amounts involved and the timing of collecting and spending of your money. Starting with spending. What do you spend your money on, and what are your spending patterns? Do you import stock from overseas that you need to pay for well in advance of selling? Or is there a value add process that delays getting your stock ready for sale or invoicing your services? While in the meantime, you need to actually pay your wages, rent, and overheads. Knowing these spending patterns is crucial to understanding the amount of OPEX or working capital that you'll need and for managing your cash flow. You then, of course, need to make sales. And again, understanding the timing and amounts will help you manage your cash efficiently. For example, does your product or service have a long lead time to a sale? Or is the purchase decision and sales process relatively short? How effective are your salespeople in getting your product into the hands of your customers? Once you have made the sale, you'll need to collect your money. Are you a cash business that collects at the time of transaction, or are you in an industry where you might need to issue an invoice for payment at a later date? If so, how long can you wait for your payments, and how much credit are you able to extend? How are you going to collect? Fortunately, new technologies like online payments and mobile EFTPOS machines are making it easier to get paid more quickly. And then finally, your cash comes back into your bank account, ready to start this whole process all over again. Many new business owners underestimate the amount needed and run into cash flow problems. Be thorough and have a good understanding of how much cash you need and how it flows through your business to avoid any cash flow issues. The final part of the creation stage is to implement risk management strategies. As a new business owner, it pays to be aware of the different types of risks that could affect the business and what actions need to be taken to reduce the likelihood and impact of these risks. It's better to address this from the outset before things have a chance of going wrong. You know, it's much easier to play the what if game now and put contingency plans into place rather than trying to think clearly during a time of crisis. Trust me, the time to recovery will be easier and shorter. A key risk to consider is product risk. What happens if your product is not right for your customer? Or if perhaps the quality is not up to expectation? Can you sustain consistent supply? Or even, what if your product should cause personal injury or financial loss? Having plans in place to address these potential risks helps to minimize the impact on the business should one of these situations occur. Another risk to have plans in place for is asset risk. What if the equipment needed to serve your customers isn't available? For example, if it breaks down or is damaged. How will you replace or repair the assets? And how will you serve your customers in the meantime? Supplier risk is about ensuring you can continue to meet your customers' expectations even if your supplier isn't able to meet yours. How many suppliers do you have? Are you reliant on one in particular? What happens if your main supplier goes out of business, or if suppliers are unavailable due to a disaster of some nature? Are there any other suppliers or alternatives that you can access? You need to also consider your people risk. This refers to something happening to one of your people that may have a detrimental impact on your business. What happens if you get sick or a key staff member is ill or leaves? Or even if one of your staff is injured on the job? What happens if you hire the wrong person? if they don't have the right skills or don't show the desired attitude and behaviours. It's expensive to recruit, so you want to get this right as often as possible. And how do you ensure that they do their job safely, accurately, and take good care of your customers? Financial risk is another to consider. This includes things like interest rates, foreign exchange rates, trade agreements, or even just the general economy. And of course, your cash flow. And finally, there's your customer risk. It's just not possible to please all of the people all of the time. So how will you handle customer complaints? Or if things get really out of hand, what if a customer takes their complaint to social media or a current affairs program? What if your biggest customer suddenly stops buying from you? Now, this could be due to their own cash flow, a disaster of some nature, or even new competition. Understanding the likely risks to your business beforehand and the possible implications allows you to plan for prevention or put in place contingency plans to minimize the impact when an event like this occurs. If you have your vision, you've worked out how you will realize your vision in a business plan, you have created the infrastructure, addressed your legal obligations and your financial considerations, then I wish you every success in starting your business. Thank you for watching our video, Starting a Business. I trust you found the information useful and helpful, and I encourage you to check out the other webinars and resources on the Davidson Institute website to help build your financial confidence. Bye for now.